Having an eye on your credit score is an excellent method to prevent identity theft and manage your money better. After all, no one wants to buy a house or car because their poor credit rating makes it impossible for them to get good terms from a bank. Keeping tabs on your credit score also makes you less vulnerable to being taken advantage of by businesses that might assume you are desperate for their services. Unfortunately, only some understand a credit score and why keeping tabs on it matters. But knowledge is power, and with so much at stake regarding financial well-being, knowing what affects your credit score is helpful information. Here's everything you need to know about factors impacting your credit score and why it's essential. What is a good credit score? There is no official dividing line in the sand to determine what constitutes a good credit score. Instead, there are lines in the sand called credit score ranges. Each credit bureau has its credit score range, but they typically fall within the following: TransUnion, 300 to 850. Experian, 330 to 850. Equifax, 300 to 850. While these are the ranges for credit scores, what matters is where you fall within that range. This is because credit scores are determined by the information in your credit report and how closely your financial behavior reflects that information. A credit score ranges from 300 to 850, with the higher numbers being better. Why is a good credit score important? A good credit score is essential for several reasons. It allows you to get better loan interest rates, lower auto insurance rates, and a better credit limit. However, the most important reason for maintaining a good credit score is the ability to get a loan. If you need a loan, for example, a mortgage, car loan, or credit card, but if your credit score is too low, you may have no choice but to pay a high interest rate than you usually would have otherwise. If you have good credit and keep it that way, you can access loans at a lower interest rate, saving you money over time. On the other hand, when you have bad credit, you may have to pay a high interest rate, which means you will pay more over time. While one or two bad loans won't destroy your credit score, if you get into the habit of taking out loans and not paying them off, it can cause your credit score to drop dramatically. How your credit report affects your credit score. Your credit report is where the credit bureaus track all your financial activity, which includes all loans and credit lines, payment history, and if you've ever had to declare bankruptcy. Upon applying for any credit, like a credit card or car loan, the company checks your credit report to determine if you are a reasonable credit risk. The credit bureaus are Experian, TransUnion, and Equifax. But what do your credit report and credit score have to do with one another? Everything. Your credit score is between 300 and 850, representing how likely you'll pay back the loans you take out. Because the credit bureaus have much information in your credit report, they can use it to calculate your credit score. Paying off debt and rebuilding your scores. If your credit score is low, it may mean you have overdue debts. On the other hand, suppose you have a significant amount of debt you cannot pay off. In that case, this will affect your credit score negatively. The good thing you should do if you have a low credit score is to pay off your debt. This will help increase your credit score, allowing you to take advantage of better interest rates when taking out loans. If you have an obligation and want to rebuild your scores, you should quickly pay off your debt as much as possible. While you can't make thousands of dollars of debt disappear in days, you can make a significant dent. The sooner you pay off your debt, it will disappear from your credit report. Tips to build good habits for a great credit score. Having the best credit score possible can be a little tricky, but possible. First, you should get a credit card and use it regularly. This way, you can build a credit history and positively impact your credit score. Another way to make good habits is by checking your credit score regularly. While your credit score can change month to month, checking it often allows you to recognize areas where you need to make changes. For example, you may see that you have a lower credit score than you had hoped for, allowing you to take steps to improve it. A low credit score can be a hassle, but you can do something about it. Start by getting a copy of your credit report and checking for errors. Once you know what to do to improve your credit score, making the necessary changes will be much easier. Remember that having bad credit can affect you in many different ways. For example, it can make getting a loan more expensive and make it more difficult to rent an apartment or get a job. Keeping tabs on your credit score is vital to avoid these pitfalls. Thanks for watching. And please like and subscribe to our channel.